The Hedgeless Horseman here. It's January 9th, 2023. Uh, all metals are pretty much up. Commodities are up. Gold, I think, actually hit 1885 earlier today. I mean, just think about it. I still remember when I don't know exactly what gold was down to, but around 1600 whatever, and it had a major breakdown, and everybody was basically telling everyone else not to be in miners. It's gonna go down to 1400, yada yada yada. It's like I didn't care about that at all. Miners were too cheap, way too cheap, pricing in way too low gold prices already. And then gold turned up, and again we're not, we're like $100 from the all-time high. So just in my opinion, a reminder that first of all, most traders don't make much money, and then if you look at gold and try to predict gold and silver, etc., and that means that if you're bearish gold or silver, or no, somebody say, hey, this is a breakdown, it's gonna go down, yada yada, so you'll sell miners regardless of what their valuation is. I mean, that's just stupid in my opinion, because the risks are so incredibly to the upside, which I showed on the Bear Creek mining chart. You didn't need to know when silver or gold was going to go up. You only need to know that, hey, these companies are super cheap. I mean, you get a 70% discount on sunk costs, etc. I mean, it's just ridiculous not to buy that because you think you have a hunch that silver and gold might go lower and somebody will sell these miners even lower, which they shouldn't to begin with. But I digress. This wasn't even the main point of the video. It's just a reminder that, in my opinion, you should always go for the micro first. Because I see a bunch of people with high beta portfolios, not even the best beta. So basically, if you buy and own bad companies or poor companies, you could do really well if sentiment, probably front run by higher metal prices, do very well in the short term. Long term, almost every bad management team or bad junior is a value destroyer. So you kind of need to be very right relatively quickly, depending on the actual characteristics of the company. Because like I showed in Bear Creek, you could be a year too early and still made money. I mean, if a trading sardine is not going anywhere, it will eventually go up. But there are some that are more like serial diluters, etc., etc. But if you focus only really on the actual companies, then you'll probably do okay even in a pretty poor market environment. You'll do good in an okay metal price market environment, and you'll do great in a bull market, for example. That's just completely different than like doing great if metals go up soon. Perhaps do poorly if they do good over time, and you'll probably end up losing money over time anyway, because you have to trade it, because they don't create as much value as they dilute. Anyway, stick to the companies, let the upside surprises in metals be a nice bonus. That's the way I go about it. I think it makes total sense just from a game theory perspective. Anyway, the main idea, or the main point of the video, was actually so I took a few hours yesterday just thinking about Magna, because it is, has become my largest position, and has been for some time. I mean, it's done so well share price wise. So I mean, if you had a big position a month ago, obviously it's going to be larger now. But okay, with that, having a large position, there's additional pressures, of course. I mean, it's very easy to hodl if you think a story is good, if you think a story is gonna be worth more in a year or two, if you have a 1% position. I mean, that's not. I mean, you don't really care about the daily swings anyway. Uh, but inevitably, pressure goes up the more you have. You know, the more skin in the game you have, the more exposure you have. And I was going to do an article, and this is kind of tying into that if you don't have a compass as an investor, you're lost. Because I have people messaged me and asked on Twitter, whatever, uh, about Magna, like, when are you taking profits? When are you selling? Yada yada yada. Basically just asking, tell me what to do, because they don't have a compass. They don't really, let's say, understand what they own. They don't really understand the case. They don't know, what the buy and sell conditions are, etc. So I thought, okay, I'm gonna sit and basically summarize where we are as I see it, and these are just my personal opinions. I mean, if you bought when I released a big piece of the new Magna, I mean, you should be up, I don't know, 100, 200% or whatever. That's great, of course, but it still doesn't matter what we're already up. I mean, we can't invest backwards. The only thing that matters in is the future. So anyway, okay. So in order to give myself some more, let's say, conviction, comfort, etc., because I also get, I feel the pressure of having a big position, because even a 20% downtrend over 2 weeks, or I mean, especially if it goes, over a day only, that that kind of affects you. Typically, it doesn't affect you really if you have, like, 1% position or whatever. That's like, I mean, 2% up and down in any junior, that's, easily done in a week with no news and yada yada. But it's like to keep my eyes on the ball. Uh, Again, what is the play here? What is the opportunity in Magna? That's basically it. Where are we now? Because we know price has gone up, but we know a lot of news are out as well. So anyway, I thought I wanted to just go through how I see it right now. So first of all, these are the currently confirmed resources that Magna has. It's even more, I think. I think I left some off now that I think about it, because I think the overall, the total resources are over 50 million per ton, but this comes out to a bit less than 50 million. Anyway, I might have left something out of Shakespeare, I think. But that's good. Okay, if we actually have even more, that's even better. So I just now had a time, like, okay, what do we immediately get in the company? What do we have confirmed? What's the value that is already there? What has all the sunk cost that's been put into these projects? What did we end up at? And we don't need to, prove up again, let's say. And that's at least 14.4 million tons at 0.66 nickel equivalent at Shakespeare open pit. Right now, I just did a quick and dirty AU equivalent, because I like to think in gold terms, which came out at 3.1 gram per ton. I mean, that sounds high, but I think that's at least in the ballpark. So that would equal, 1.4 million ounces of gold gross near surface. If we just assume a 70% recovery, 30% recovery loss, because this piece here, or what I've done here, is me trying to be conservative. Because we can always point to something and say, hey, in a blue sky scenario, it could be worth this, and we're trading at that, so it's a buy. It's like, yeah, but a no-brainer, especially from a margin of safety and risk reward, should be like, it should be a no-brainer even if you're conservative. Because then all the upside beyond that comes free. So you're pretty much sure you're not overpaying. Because for a value investor, overpaying or underpaying is all that matters. And obviously the degree of underpayment and overpayment. So if we have a clear case based on conservative assumptions, that's a really good case. Because any junior has the potential to go up 100% to 1000%. Cases I really love are the ones that have a high probability of going up 100% and could still go up, let's say, 1000% or 500% or whatever. It's like probable is way better than potential, because any junior has the potential to go up 1000%, but the odds of that is probably less than 5%, assuming not, you didn't exactly buy the sentiment low and waited for, a 2011 sentiment high. Then you wouldn't need to do much in a company for it actually to 10 bag. But we can't just assume that those kinds of opportunities are always presented to us. Anyway, so Greenhill open pit, 16.8 million tons, 1.08% nickel equivalent. That comes out to around 5 grams per ton AU equivalent. That's 2.7 million ounces gross. If we take net 70% recovery, that's 1.9 million ounces open pit at 3.5 grams per ton. That's really good, obviously. Greenhill underground, the high grade, 2.07 nickel equivalent. That's 9.6 gram per ton AU equivalent, around that. That's 4.5 million ounces of high grade. Net it's 3.15, so over 3 million ounces at 6.72 grams per ton AU equivalent. So total resources, it might be higher, because I think we actually have 50 million tons. Anyway, total resources gross, if we just do a quick and dirty calculation to gold equivalent, it's 8.6 million ounces, excluding recovery loss. That's including 30% recovery loss, that's still 6 million ounces at variable grades. In Sudbury, pretty much fully permitted, best infrastructure you can ask for, best jurisdiction you can ask for, toll milling, etc., etc. So if we just use this, like, if this was a gold play with 2 projects, they had 6 million ounces, one of the best teams in the world, near-term toll milling potential. That would probably be the hardest gold play in the entire space at these valuations. I mean, just think about it. Not a lot of juniors have 6 million ounces, let alone permitted in the perfect place, in the perfect jurisdiction with the perfect team, and could actually become semi-self-funded, and then you have the potential of grants, etc. Anyway, so let's look at a few ways to just do some peer valuation, because this will act like a magnet or gravity, basically. And I'll go over that a bit more soon. So total resources, I guess it's, if you use 2 decimals, it's 8.64 million ounces, or net 6 million ounces. Okay. And I use from the presentation, they state current 1.3 billion pounds of nickel equivalent. I read there was one post on the forum where someone said the comparables average 0.73 per pound, meaning that's what I think developers in the nickel space, let's say, trade at, according to that guy. I'm not 100% sure if where he got it from, but I think he got it from another Nickel Juniors presentation. So again, this is like a peer average in that case. That would mean that if Magna Mining would trade at peers, it should be valued at 949 million. I also read another piece or article which stated, or a table, I think it was the one Doc Jones posted. You had anywhere from 0.6 US dollars, or 6 cents per pound US, to, I think Talon was trading at 56 US cents per pound. Anyway, if we just use the average, let's forget about Talon for a moment. If we used that peer average valuation, it should be worth, calculated to Canadian, 416 million. So just based on resources already in hand, meaning excluding all future upside, or excluding all future possible mergers, acquisitions, what it would trade at when it became a producer, etc. Again, excluding any exploration potential at all. We assume not a single ounce of anything or a pound of anything was found. One could argue that Magna should be trading between 416 to 949. Obviously, Magna doesn't trade at that valuation yet. So this is kind of, think about it as an inherent magnet, basically, because anybody who looks at Magna, etc., and we know, I mean, the sector average, etc., that's basically consensus. So at any point somebody comes across Magna and sees, a spreadsheet or compares to his other junior or whatever, or juniors overall, he'll see that, hey, I think this looks cheap because other juniors are trading for a higher multiples on their resources. So that's gonna be a chronic magnet, basically. That's gonna seep through, the more people get aware of it, yada yada. So this is like until this gap is closed, this will be let's say an emotional charge to the upside. Because as long as this persists, somebody can come across Magna and say this is too cheap, just based on what they have already confirmed. That's really good. And then just cash flow, because unlike most juniors, Magna can actually, has the potential to actually get into production and way sooner than most. I mean, Talon, some think that could get into production in 2026. At least that's what I think the deal with Tesla suggests, that, we want you to be in production 2026. Who knows if that's going to be the case? I don't think so, but that's 3 years from now. Magna Mining might be toll milling, let's say in around 12 months from here, possibly toll milling. I think they pretty much have all permits. It's just that they need, well, first of all, they need to decide obviously what's the best path forward, etc., but also have, agreements with the stakeholders. But from a permitting perspective, I think it's pretty much fully permitted already. That is unlike any other junior, especially nickel PGM junior that I know of in North America. It's why Jason said, well, when he was asked if we compare you to your peers, and he basically said, well, he literally said, we have no peers. There is no nickel PGM junior in North America that is as advanced as Magna, with the possibility of, for example, toll milling, and have a permitted mill site. So when he says we have no peers, that means we're actually much better than any other junior from a quality perspective and de-risking perspective, which kind of ties into this, because this is comparables to average. Magna is not average. Magna is far from average. Magna has no peers. That's why I think the true value should be closer to 949 with these resources, given the stage and advanced de-risked nature of Magna. Anyway, here are just some toll milling scenarios. I used a base case where a nickel price is $10 Canadian per pound. I think it's closer to 18 today, or maybe 17. So considerably higher, considerably higher. So I'm using, again, a very conservative estimate that nickel would need to fall like 30% for nickel to be trading at $10 per pound. So that's really good. Again, if this is a no-brainer at much lower nickel prices, then you can imagine what it is at today's nickel prices, etc. I could use today's prices, of course. These numbers would look dramatically different, and there's possibilities of even higher toll milling scenarios. But again, I want to be conservative. I want a no-brainer to be screaming at me. So if we just use scenarios 300 tons per day to 1,500 tons per day, and we just take an average here, which would be slightly less than 1,000 tons per day. That would be the average pre-tax profit here in these scenarios, which is a production scenario a bit less than 10,000 or 1,000 tons per day, would give pre-tax profits of $40,500,000. If you just 10x that, from a valuation perspective, 405, which is kind of aligned with this. And again, there's possibilities of going way beyond 950 or whatever tons per day, and assuming much lower nickel prices. Because if they were to do that today, this would be considerably higher in this scenario than 40 million. So it's like, okay, conservative nickel prices, conservative toll milling scenarios, you get 40.5 million pre-tax per year. And just 10x that's 405 million Canadian. And obviously that would be a relatively small operation. If you look at that, that's like 350,000 tons per year. And you can see how many tons they have. Even just the high grade underground portion is at 14.5 now, excluding all exploration. So this is basically would be a production scenario with no, theoretically that would last for decades. Then we also have a Mitsui MOU, which put an implied value of the Shakespeare deposit alone at much lower nickel price, well, at 22,000. I think it's at 28 now or something like that. Anyway, quite a bit lower nickel prices. For the Shakespeare deposit alone at 64 to 100 million. So we obviously need to bump that up, reflecting, at today's prices. Right now, it should be worth a bit more than that. And I think there's a reason why they didn't pull the trigger, at least yet, on that, because I think it should be worth more. But then we have to factor in that Green Hill makes up the vast majority of metals at higher grades, both open pit and obviously underground. So again, if this is what Mitsui, a third party, big multi-billion-dollar conglomerate, suggests this is maybe fair value at lower nickel prices for Shakespeare, we can just imagine what they would say the value is of Green Hill, and for Magna shareholders what that would mean, what the whole company should be worth. I would say materially more than this. Materially more. If we just, triple that, given that Green Hill is at least twice as good as Shakespeare, that's, 64 times 3 to 300 million. And that's at lower nickel prices. Add the higher nickel prices, maybe, I don't know what that range goes up to. But it's like, yeah, okay, considerably more than this. Additional value factors. growth in resources, because obviously when we take a stake in a company, we own everything the company has. What is already confirmed, which is 8.6 million ounces AU equivalent of gross resources, 6 million ounces of AU equivalent ounces net recovery. So we own a multi-million ounce or two, which makes up a multi-million ounce company. But we also own all the future potential in creating more ounces. I don't think we're gonna stop at 1.3 billion pounds nickel equivalent, or 50 million tons, because that's becoming kind of obvious with the recent exploration drilling. Well, I mean, some is more infill stuff, but it's like, yeah, it's probably gonna add ounces on the books anyway, or pounds on the books. So this is will grow. The per pound, if we increase the pounds we have, obviously that's a pressure higher on valuation. So growth in resources, I tried to just estimate, okay, we know what we have, but what will we have as well, and then try to risk adjust it. So growth in resources, probable and moderate impact. That's just my assumption. I put a $50 million net present value on the exploration potential, in mostly infill, not infill, but contact style mineralization. I mean, just a hint why that is, again, just the recent hits. And today, for example, they came out with a new barn burner in the and this wasn't the contact style, this was footwall mineralization. That's where these PGMs, I mean, this is bonanza grade stuff, obviously. It's not that it's only 20.2 grams per ton, PGMs and AU in this over this 7.1 meter. It's 2.8% copper and 3.7% nickel. I mean, this alone is bonanza grade nickel over 7 point. But you have bonanza PGMs plus AU as well, and 2.8% nickel, which also shines a light on the fact that yes, Green Hill is a polymetallic system. So it's not only nickel. We can't just look at nickel price. If something happens with nickel, for example, but if nickel went to zero and these other metals just stay put, that would be quite some profitable ore right here. If this went to zero, if palladium, platinum, and gold went to zero, these would provide very big margins anyway. So that's what I really like. There's bonanza grade stuff here. It's polymetallic, so we get internal diversification via metals mix. And and obviously, I mean, grades like this would pretty much work in any price environment. That's also what I really like. The fact that, okay, these value assumptions are based on, especially this, on lower nickel prices, quite a bit lower nickel prices. But we're finding bonanza stuff and high grade stuff that is kind of protected against lower nickel prices as well. Because I think that's a natural fear when you have a big position. You're thinking like, oh, what if nickel actually crashes? What if nickel crashes? You read somebody say, we're going to go into a hard recession or whatever. I think we're pretty secured against that, because these are so high grades. And again, it's, especially in some places, polymetallic, where, I mean, they could be producing PGM rich stuff, especially if they drill up more of that. Because I think platinum is kind of breaking out to the upside. Palladium, I've seen some charts or some articles which think that there's might be very high demand from, I think, hydrogen cars or whatever in the future from for palladium platinum. If that will end up being the case. I don't know. I just know that COMEX is almost out of platinum, for example. So it's, again, you're kind of, if PGMs do well, especially let's say it's a very chaotic world, maybe PGMs, including obviously gold, but also palladium and platinum, might do very well. Okay, then you can mine that stuff and let nickel recover, whatever. Or we go into, let's say blue sky nickel scenarios, because nickel prices are already high, and you've seen the report which states that we need 60 new nickel mines, for example, by 2030 or something. And we know Jason thinks that there's actually a floor for nickel at, I think, around, he believes the floor is around $10 US per pound, if I remember correctly. So that's higher than the base case here, because this is Canadian, which is like, this would be 7.7 US dollars per pound. Anyway, potential for footwall discoveries, potential but high impact. Basically, we don't know for sure, but that's incredibly rich ore. I just risk adjusted that down to 75. I mean, I wouldn't necessarily call this a discovery because it's in the 109 footwall zone here. So I don't know if they consider this to be a pure discovery. We know the 109 footwall zone is already there, but I think this could grow, and I think there's a possibility when you follow these out that it becomes more concentrated and you go into a more pure footwall style mineralization, let's say, because this obviously had a very high grade nickel in it. Still, it highlights that there's a lot left to explore, and some of that might be 3 different zones of footwall style mineralization with bonanza grade PGMs. So I think this is lowballing it, but let's say that potential is at least worth 75 million risk adjusted. We have the potential for, let's say, up to 100 million in grants, around half the capex. If we put a 30% chance of that happening, that has a net present value of 30 million. Potential for more value creating M&A. Again, we have to factor in the team here, and they say, they've said that they are continuously looking for more stuff. I mean, Green Hill, they have been aware of Green Hill since the FNX mining days. Jason Jessup lives in Sudbury. He worked at FNX Mining. He worked at Vale. He worked at Inco. These guys know the Sudbury region probably better than most. And we know what Green Hill was worth. They purchased it for 16 million. 16 million for this and all exploration potential. So the value creation in that is obviously, I don't know. I mean, just right now, given the revaluation, that's worth at least 100 million. Or it has been worth at least 100 million for shareholders. And I think that's gonna, somewhere around 100 million. And I think it's worth a lot more than that, given, again, just peer valuations, potential cash flow scenarios, etc. But let's put that at 50. Potential for value of higher toll milling scenarios and commercial hub and spoke mine, plus minus grant money. I mean, that's going to affect valuation a lot. I mean, if we get 100 million grant, obviously that's like, at this valuation, 100 million would be, not too far off from the current base market cap of the entire company. So in that case, they would have 146 million or whatever the market cap is, 100 million in, pledged cash. So it's like you're paying 46 million at face value for the actual assets. I mean, you can understand how big of a deal that would be. But again, it's like potential value for higher toll milling scenarios, given that this might go way higher in the hub and spoke. So this is kind of hard to value, but it's like, I think it's kind of supposed to reflect how conservative I am with this. So let's say that's 80 million. Contextual premiums. Okay, why should Magna fetch a higher valuation, all else equal, versus most peers? Management team's track record. They built a over $1 billion success from toll milling in Sudbury, starting off with Old Valley/Inco mines. That's exactly what they're doing. Not only do they have the track record, they have the track record of doing exactly this. It's not some team that found a mine in Africa and now they're looking for some mine in Canada. Maybe a different type of system. Maybe they found a VMS and now they're looking for organic gold. No, they have specifically this kind of competence. Specifically this kind of value creation. Putting old mines into production and finding new discoveries at said mines. You cannot ask for a better management team. So I would say this alone, which we're seeing right now with their exploration success and the Greenhill acquisition, should demand a premium. Management skin in the game. The CEO owns, I don't know how many shares he owns, but a considerable portion of the company, and at 146 or whatever the market cap is, that's a considerable amount of money. Very incentivized to create value, not incentivized to just take a salary and not create value. And I think overall management and the insiders own 14% of the company. So they're thinking about Magna every day, and it's way more beneficial for them to create value and get the share price up than it is to just take a salary and just roll their thumbs. Project's location. You can't ask for a better location. In the heart of Sudbury. And yeah, of course I'm going to get to jurisdiction premium, but close to 3 majors, 2 big mills, labor market, infrastructure, everything you need. It's not in a remote place somewhere where it takes a lot of infrastructure or, it's going to be hard to permit, etc. Critical minerals. If this was gold, they wouldn't have the option of or possibility of getting any grant money. Now, the nickel and copper is deemed critical minerals. Governments actually want these mines. While sadly, gold and silver mines are not deemed to be critical minerals. So there's actually tailwinds for for mines like this, which is almost unheard of, I would say. And that's why this is such an unique time to be nickel miners. Because the government and US Defense Department is actually actively encouraging development. Potential to have very high margins at today's prices. Again, this is not some company that might be in production in 6-7 years. And we know that high margin operations get high premiums. Agnico Eagle is a multinational gold miner, and I think they have around the lowest costs of the majors, and they typically have a big premium. And just look at whatever, it's like Foster Will and stuff like that. High margins makes people comfortable. So this is not a low-grade beta option play. These are very, 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 very high grades. 3 majors nearby, obviously. So it's like if they built something it would even move the needle for a major, and we're talking 80 to $100 billion companies. Obviously, there's quite a few natural buyers, and we know Vale is set to spin out a base metal unit with it's going to focus on nickel and base metals, etc. And they're obviously nearby. Jurisdiction premium. Again, Canada. all else equal, if you had this project in, I mean, there's some nickel juniors in Brazil and Africa, etc. Where would you actually want to own two high quality, let's say, nickel mines, near-term production, actual cash, somewhere where you wouldn't want to wake up and get that taken away, for example. And you also are in smack in the middle of, a major mining region. It's in Sudbury, Canada. That's probably as safe as you can get. Yeah, fully permitted. These peer averages, I don't think those projects are pretty much fully permitted, and or could grow from or get financed from internal cash flow because they don't have the toll milling option. So I mean, a junior, if they had the resources that Magna has, it would still take years with no guarantee of success to actually get them fully permitted, and it would obviously cost millions. Magna already has that, so their ounces their pounds of metals should be valued much higher than the average junior. And of course, like I said, potential near-term producer. Nothing of this suggests that Magna should be valued at peer average. Because like Jason said, they have no peers. No other junior has all these. No North American nickel, copper, PGM junior has all these traits. This puts Magna way above average, and I would say puts it above Talon. Talon has a lot of exploration success. They have good drill intercepts. We've already shown that, I mean, the last news release with that, what was it, 30 meters of, I don't know, 6%. I mean, that's crazy. That's pretty much on par with Talon's best hole ever drilled so far. And these, we've just seen the first 3 holes. Sure, they pretty much know they were gonna hit some mineralization, but it's like, obviously you can't pinpoint an area where you have there's literally no drill results in it yet. So I mean, it kind of highlights just how high grade some of this ore is, which is what the reason why Jason said in an interview, I think the assay results might shock people because nobody has really seen what a Sudbury type polymetallic system can deliver in terms of grades, because there hasn't been an active junior in that Sudbury area since the FNX days. I mean, they're putting out barn burner results, which any nickel junior would kill for. So, and here we go to the valuation. Okay, it was actually a bit higher. Basic market cap right now, 168 million. 0.2 Canadian. Cash around 9 million, let's say. Enterprise value 159, which is 126 million US. Let's look at, because these warrants, there's a bunch of warrants which are in the money. So let's look at fully diluted, because we're taking a longer term perspective here. Okay, fully diluted today, that's 223.4 million Canadian. That would with the warrants, 23 million in cash, enterprise value of 200 million, 167 million US in enterprise value, fully diluted with all the warrants. And of course, this just shows kind of fully diluted. If we get $100 million grant, that would leave fully diluted 100 million for an enterprise value to reflect the value of all the assets, which is obviously absurdly low. Absurdly low. Again, if we go by Talon's valuation, we perhaps should be closer to 900, for example. Anyway, conclusions. Okay, this is what has me very happy with my very large Magna position and why I'm not selling anytime soon. As at least that is my current thought. Conclusions. Conservative value around 400 million. And this is excluding upside value. This is just based on what we have already confirmed and based on peer average. So this is, in my opinion, a very conservative estimate. Magna should easily gravitate towards 400 million in market cap. This again assumes if it was an average junior, much lower nickel prices used, because that's my toll milling scenario, no upside potential included. So this is obviously stuff as an investor you should account for. But just to show, just in my opinion, how good the opportunity still is, a conservative value, assuming no other upside, and even excluding, let's say, most if not all of these traits, 400 million. Higher end value, around 900 million. But this is still excluding upside value from any exploration, any mergers and acquisitions, etc., etc. But it does reflect, well, partially at least, Magna's way above average characteristics, meaning all of this. Taking into account the quality, the risk nature, advanced stage, management team, well, critical minerals. It's a critical mineral in Canada at least. Jurisdiction and location, etc. Then one could say, no, maybe Magna's fair value right now is actually closer to 900 million. And interestingly, I mean, that is closer to Jason's pledge, that when he said, I won't sell a single share until Magna is at $1 billion. So this is starting to make sense why, Jason said such a thing, which might shock people. But if we're really rational about it, and again, include all the things we should include, and this is not even really including the upside potential, but then we actually are getting close to 1 billion. And if we include the upside value, meaning if we include additional value factors, that they're probably going to find even more resources, potential for real footwall discoveries, potential for getting grant money, potential for even more mergers and acquisition, potential for higher toll milling scenarios, and get into a commercial mine, and or including 100 million grant. Then we get into a final value range here, just based on what is confirmed, 400 to 900 million. Confirmed plus known, meaning, okay, confirmed based on all the success and value that is already there in hand, let's say. And then we include also include the value of exploration potential, value of possible grant money, value of mergers and acquisition, value of footwall discoveries, value of the production scenarios, etc. Then we get to 685 to 1,185 million, and that is a mean of 793. I'm just looking at. Yeah, okay, so which leads me to believe that probable upside still, just based on how everything looks right now, is 200, especially price to value gap, because here I use the enterprise value based on everything that is known, because then I include cash, because obviously if they spend the 8 million and create 50 million in value, that's a value add. So I just want to know the enterprise value today versus the, let's say, lower end, the most conservative fair value scenario. So from the current enterprise value, Well, I even used. Okay, I actually used fully diluted. I didn't think I did that. But this should actually be 100% in that case, obviously, because 200 to 400. I don't know why. And this might be actually 430. But that's like, okay, a probable price to fair value gap of 100 to, let's say, 430%. That is a meaningful, my goal, return goal is 50% per year every 12 months. This is a 100 to 430% gap, price to value gap implied right now. Just based on what they have, we should go up by at least 100%. So basically that could happen at any point in time. So you're not waiting for a catalyst really. That's just, okay, assuming easy 100% return, it's a matter of when, not if. I don't find too many of those stories around, but it might be closer to it should go up 430%. That is why, in my opinion, Magna is still the best case I know of. And I know this is what makes it so interesting, because people, I mean, it's not too shocking, but it's like they've seen the stock go up, and people don't want to buy because they feel, oh, people are already up, etc. That is totally irrational, or that's totally irrelevant. If there was no upside left in Magna, especially no probable upside left, I wouldn't want to hold Magna. If I think there's 100 to 430% of probable upside left still in Magna today, based on what the world looks like today, based on what Magna looks like today, based on everything we know about Magna today, it would obviously be kind of foolish to sell something like that, because you're leaving 100 to 430% of risk-adjusted returns on the table. And that doesn't grow on trees. So, I mean, what I really like to do is, which kind of cements my, let's say, conviction in Magna, is when I compare it to other cases. So I have some, gold and, let's say, silver juniors. They might be trading at half Magna's market cap, whatever. But they might be 2-3 years away from having a resource which Magna already have, which is obviously not even guaranteed that they'll find. 6 to 8 million ounces of gold equivalent. I mean, how many companies even find that? That's not many. That's not many at all. So there's obviously no guarantee that an explorer will even reach that kind of metal endowment. And they would need then to go into years of permitting, etc. You would need them to be in a tier 1 jurisdiction and a location as good as Sudbury, and with the best possible management team you can find. I mean, when you think about it, it's like, I don't know a single gold silver junior I know that fits that description. I don't think I know, at least. Well, first of all, I don't know a single one that has all those traits and is up at 6 to 8 million ounces AU equivalent already, with 2 fully permitted projects in the heart of an area, a mining region, a mining hub like Sudbury in Canada. So the funny thing is, when I really thought about it, doing this, let's say, refresher on Magna, what the actual case is, I was like, I should probably buy even more. And that's kind of crazy, because some days I'm like, I have so much in Magna, people would call me crazy. But then when I really think about it and just compare it to all my, top 5 best case or top 6 best case, and I'm like, Jesus, Magna is still like 200% better than that case, and that's in my top 5. So it's basically what I think, these, my top 5 case might be, top 1% in the space, and then Magna is like, 200-300% possibly better risk reward than that, which then makes me go like, I actually maybe should have more in Magna, because I can't find a single case if I just compare it relative to gold and silver space. I know companies that have the potential to find something like at least 3 million ounces of gold, to maybe even 6 or higher. I mean, Snowline, for example, probably has over 10. But Snowline is, first of all, twice the valuation, and they're obviously probably like 10 years from production, etc. That doesn't mean Snowline is not a good case, but from a risk-reward perspective, here we already know how much they have, Magna. And they're obviously going to find more of that stuff in the best possible jurisdiction you could want, in the best possible location you could want. So I'm like, again, other juniors I know that, there's silver juniors in, let's say, Mexico with like, I don't know, 150,000 million ounces of silver. Would you really want that instead of, for almost the same price than Magna? No, I think this is, multiples the risk reward versus a typical, let's say, higher beta silver play. So it's just, this is what I like about investing. It's like, everybody looks at something completely different, and you have to take different angles to get, flush out the conviction. How good is this case actually? Because if I just look at how much I have in Magna, I, get a bit paranoid. But when you really think about it and compare it to your other stories, then it's like, well, if that is a no-brainer, what is Magna? Because if I like a company that might have, let's say, 3 million ounces of gold, might have, and that might take 2 years more to flush out, and they might not have it in an indicated resource even, and then it's like, if we're talking permitting, etc., I mean, they haven't even begun permitting. Certainly not, the option of being able to toll mill and grow organically. Then it's like, I mean, it really almost has no peers, I would say, not even within my portfolio. Yeah, so that's where, compare it to other cases, because that's what I find is the best way to really flush out. Because I've been looking at some micro cappers recently, and all of them look pretty good. But when I compare them to each other, it's like, okay, you have micro cap junior X and Y, and it's like, both, at surface, both look quite cheap. But when you compare them, it's like, if you could only own one, typically one will, it will be obvious that one is better all of a sudden. So you went from like, both look good, to like, yeah, but if I actually compare them next to each other, this junior hands down looks like better risk reward. So you have to, that's a, kind of a hack, let's say, to how to flush out the best cases and how good a case is compared to everything else. Can you trade up? Can you find something that has more margin of safety, growth potential, etc., and fits all these descriptions like Magna, and is cheaper? No, you can't. You cannot find that. Which means that, okay, then this must be one of the absolute best, risk-reward cases still. Does it fit with a probable 50% return over 12 months? Yes, I think it should go up, and it will gravitate towards a fair value, which is somewhere around 100 to 430% higher than where it is. And that could happen any day. I mean, it appears that a fund started buying Friday, for example. And think about that. When people are asking, should I take profits? The run is over, perhaps, or whatever. It's like that fund is saying, we're happy to get in here. We're happy to start the journey. And if they're getting in here at $1.15 per share, they're obviously not looking for $1.20 per share to get out. Maybe they think, hey, this looks like, we might get 200% in Magna from this level. Again, just based on, let's say conservative, that's at least 100% return, up to obviously more. And in my opinion, maybe the closest to fair value of Magna right now is like 793 million. Even at the fully diluted market cap, we're at 223. So there's obviously room for upside, and this would not be like potential upside, like if they are getting incredibly lucky, there's a 5% chance it actually could be worth 793. No, maybe it actually right now is worth 793, and then obviously could get be worth a lot more than that with time, as you let these value creators create even more value. So time would be on our side. But again, this is getting closer to why, it becomes more, when I did this spreadsheet, it becomes more obvious why I can see why Jason said that he won't sell a single share until they reach 1 billion. And then one last thing. Magna Mining has the advantage of having both substantial resources and production potential. So most people, or most juniors obviously, will be like beta plays. They might have some resources, so they're valued at their resources only. So not only that, we're cheap based on just, again, what we have, but we also have the production potential. And right now, the revaluation to developer peer is the main carrot, or easiest thing to do, because we can't be valued as we can't have the premium of a cash flowing operation because we're not cash flowing yet. So right now, just based on peer valuations for companies that are advanced companies with a resource, that's gonna act as, I think, the main magnet, like 100 to 430. Once in production, it will be cash flow driven all of a sudden. So I really like that, we kind of can transition from, okay, we should be revalued higher based on the resources we already have. And then we could go into cash flow, and then obviously that will take charge again. But right now, without doing anything more, we should revalue just based on the resources, and then this might get into a cash flow story. And perhaps, we might have a lot of cash flow in 1-2 years. And that's going to demand an even higher premium than just how much we have in resources, assuming the production works, etc. And these guys have done it before, so I think, unlike most juniors, these guys will actually be able to pull it off. And until it is more a cash flow driven company, until it is more cash flow driven, the company will do significant resources expansion and exploration drilling at both Green Hill and Shakespeare. So that's what I also like. That even if, let's say, we are not into toll milling in 12 months, but in 18 to 24 months, just take that as an example. If the only catalyst you wanted to see was if we go into cash flow. No, but if we're cheap based on resources already, because I've seen a gold junior that has the same market cap or slightly above actually market cap than Magna. They, I think, have like 500,000 ounces or so. They're kind of, they're thinking of actually developing it, and it's very high grade, so that's, that you have to account for, but not anywhere close to the, location and jurisdiction, etc. So that's obviously driven by the cash flow potential of those high grade ounces, because you see 4 million ounce companies trading for way less than, let's say, 150 million. So that, again, high potential of high value production brings a big premium. But until then, even again, if it takes 12 instead of 12 months, it takes 18 to 24 months. I expect them to keep drilling. So they're going to be increasing these, the amount of metal they have, while they're also de-risking it closer to production. So I think, unlike most stories perhaps, where it's like, okay, now we have a mature project, we don't do any more exploration drilling, and now we're gonna try to get into production, and maybe that's they have to finance it, maybe $400 million. It's gonna take 3 years to build, and in the meantime, they won't do anything else really to, add to the blue sky or whatever. They're just de-risking, meaning they're in the quote boring period of the Lassonde curve. Magna is potentially a lot closer to that, thanks to being able to possibly toll mill, but they also will explore, and some of the main catalyst is actually exploration, like more these footwall style mineralization. And think about it. I mean, we've seen 3 holes. Every hole has been a barn burner. They're gonna do, I think, 15,000 more meters starting this week or something like that. Maybe, well, soon at least. So you just imagine how many news releases with like intercepts up to the. I mean, not every hole will be a barn burner, but it's like, where do you think Magna is gonna trade if we get like, I don't know, 5 to 10 more hits like this? Well, actually even more perhaps, and then they make an actual, new discovery in the footwall. They have 3 areas where they are looking for more, and they expand the contact. There's not going to be any shortage of just the value creation. Meanwhile, the de-risking process goes on in the background, and then so we're going to have a revaluation just based on resources we have. They're going to add value via exploration, and that includes some barn burner results, which is going to put a premium or a pressure to the upside. Meanwhile, then they can probably transition into becoming a cash flow operation and have the premium bump from being a actual cash flowing business. There will be no pause in growth during the de-risking phase towards production. That's what it looks like. And again, it's like Mr. Market will want to close the Magna to peer valuation gap. So yeah, I hope this was a very long rant, but I think this is, and I wrote that before, this was probably the best case I've seen in 7 years, which means it's the best case I've ever found in the mining space. And I hope this kind of shows, first of all, what makes a good case. And there's no guarantee still. I mean, but what makes a really great risk-reward case, and why I am not selling yet, and might even add today. That was my impulse when I was sitting and doing all this. So I'm not. You do exactly what you want. Obviously, I don't want to. If you're up a lot and you want to take profits, take profits. If you have a profit, you have a profit, and a profit is not a profit until you take it, etc. I personally think there's too much on the table still of risk-adjusted upside. I'm not taking profits. I would feel stupid because I don't, even after the run-up, I don't see really a case with better probable returns than Magna right now. So by definition, I don't want to sell the best case I know of. And certainly not just because it's gone up 150% or whatever. Well, 100% I guess in the last. Well, I don't even remember where it started at, but whatever. I don't care what it has gone up. I care about how much is left to go up, and with a pretty good probability, I would say. Anyway, thanks for listening. Obviously, consider me biased. You do exactly what you want to do. You are responsible for your money. This is not a buy recommendation. This is not investing advice. Again, I am biased. I own a lot of shares of Magna Mining. It is also a banner sponsor of my site. So, yeah, do your own due diligence. Think for yourself. take responsibility, learn how to fish. If you like this, I hope you hit the thumbs up button. Have a great day. Bye.